Hey folks, Monday, June 24th. Thanks for tuning in. Chris Versace here. We're starting the final week for not only the month of June, but the current quarter. And as you can see below, quarter to date, the S&P 500 is up about 4% and up more than 14.5% year to date. Well, that's great, but the good news, or better news I should say, is that when you look down below on the table, you can also see that a number of our thematic models and strategies are outperforming the S&P 500. Aging of the population, AI, the CHIPS Act, data privacy, EPS diplomats, and nuclear and uranium. Now, last week, as we know, was a bit of a funky week. I say that because we had a rare occurrence when the stock market was closed on Wednesday. That was, of course, in observance for the Juneteenth holiday. But the week also brought the flash PMI report for July, courtesy of S&P Global, and it showed some very positive things. First and foremost, the economy, both due to the strength in manufacturing and services, continues to grow above trend. Very good news. We also saw employment move higher. We got signs that real wage growth is continuing, but when we looked at input and output costs in the flash PMI report, boy, that really was the standout. It showed further improvement compared to recent months. That's more of that good data that the Federal Reserve wants to see. The negative here is that, a lot of folks don't necessarily incorporate the data from S&P Global. They tend to refer to the ISM manufacturing and services PMI reports. We won't get those for a couple weeks, but I will say that the data that we saw in the flash June PMI report from S&P Global, extremely supportive, suggests that we could see a soft to no landing scenario. But again, we'll look for more confirmation in the upcoming data. We also have a number of Fed speakers this week, more than half a dozen, really closely clustered around Monday, today, and Tuesday. I think, though, that they're going to continue to reiterate the notion that, wow, recent data has been supportive, constructive. You use the word that you want, but I think ultimately they're going to continue to stick to the recent playbook of, we have seen some improvement, but we're going to need to see more because we don't want to be head faked. And when you trace back the core CPI data, that's totally understandable. We did see similar levels to the May report back in the second half of last year, only to see the CPI data and the core CPI data reaccelerate. So I think the Fed doesn't want to be head faked. That tells us that the market will be looking for confirmation later this week with the May PCE price index. And as many people have talked about, that is the Fed's preferred inflation metric. But we'll want to see progress on a year-over-year basis and on a month-over-month basis. But remember, that's the data for May. So we're looking for more confirmation for what we saw in the already published CPI and PPI reports. Alongside that report on Friday, we'll also get personal income and spending for the month of May. We'll want to see more granular data. Where are people spending? But we'll also want confirmation that we're seeing continued real wage growth. That's a nice indicator for consumer spending. There's some concerns about outstanding debt levels, but to the extent that we see continued real wage growth, it tells us that consumers, generally speaking, still have some more firepower. We do understand that there are certain pockets, particularly among lower income consumers, that are a little more cash strapped. That plays right into our consumer inflation fighter model, which has been doing rather well. And we do see that continuing to do well in the second half of the year, which tends to be seasonally stronger for consumer spending. Take all the comments on inflation, and we've seen the yield on the 10-year Treasury come down. We're back at levels we haven't seen since March. That's right around the 4.25, 4.22%, 4.26% level. But again, we're going to want to see further confirmation from the data later this week. Again, folks will be reading into comments out of the various Fed heads, but all in all, I wanted to point out that the move down that we've seen in the 10-year Treasury yield has really led the market in part to be once again overbought. We can see this in the S&P 500, the RSI levels above 70, right around 71. NASDAQ Composite is also still above 70, telling us that that is overbought. But interestingly enough, when we look at the S&P 500 equal weight index, that has an RSI that's far more neutral, somewhere close to 50. And this is simply another way of telling us that the market has really been driven by big tech and by AI. And when we look at the quarter-to-date moves in whether it's Apple, Qualcomm, Nvidia, Google, or some others, it's really no surprise. So I do think that the market's going to be, we're probably going to see investors this week kind of sit on the sidelines, close out the quarter. I do think that the next big catalyst for the market outside of inflation data is going to be the June quarter earnings season. I say this because we've seen the market really come, quite a distance the first half of the year. PE multiples are, I won't say stretched, but they're bumping up against the highs that we saw for 2022, 2023. So we're going to need to see earnings growth accelerate, most likely more than expected in the back half of the year. Again, that is for the market to move higher. There are individual cases, obviously, for stocks that can simply continue to power ahead as they deliver faster earnings growth. If you think of our models, they're kind of positioned for that. Again, from a thematic perspective, we look for structural change, and we look for companies that are poised to benefit from that across the shifting landscapes of economics, demographics, psychographics, and of course, technology. One other thing that we have to focus on this week is that even though we are toward the end of the current quarter, 5 days left, there will be a trickle of companies that are reporting this week. And those earnings can be pretty insightful for what we're going to hear in the next several weeks as the earnings season really kicks into gear. So we could get a preview of some of the key topics. Some of the companies that we'll be listening to: FedEx, Nike. What are they saying about the overall global economy, about FX and currency, and with Nike too, the consumer. We're also going to hear from Micron. This is going to be a big report given the end markets that they touch, some that have been really driving the market, as I just alluded to. I'm referring to their comments on PCs and the PC upgrade cycle, particularly AI PCs, smartphones, and of course, data center. And then we'll get another look on the consumer when we take a look at earnings from General Mills and McCormick. If you look at last week's retail sales report for the month of May, we did see some softening in restaurants, but we did see continued strength in the grocery category. So the outlook from these companies will kind of tell us a little more not only on inflation, but are consumers re-engaging at the grocery, eating more at home, just given some of the data that we've seen on restaurant prices. So that's the week ahead. Be sure to tune back on Tuesday and Thursday for more ripped from the headlines thematic signals for our models. Thanks for watching.